Good morning, everyone. I'd like to begin by welcoming members to the Pension Fund Investment Subcommittee meeting, including members of the public watching via the Council's YouTube channel and local pension board members observing via Zoom. Please note that there is no fire alarm test scheduled for today, so if the alarm sounds, I will adjourn the meeting and we will all make our way downstairs now to the main entrance. The nearest fire exit is through the middle doors to my left. The muster point is in the car park. Can I ask that everyone present turns their mobile phones to silent or vibrate whilst the meeting is taking place? Thank you.
Apologies, Chair. May I just ask that you angle your microphone a bit more towards your mouth, please? Thank you.
Sorry about that.
Yeah,
Sorry about that. I've got a few problems at the moment. So if there is any problems, please just let me know. Okay, item 1, apologies and declarations of interest. Daniel, do we have any apologies?
Thank you, Chair. We've received apologies from Councillor Ray and there's no substitute.
Thank you. Does any member wish to declare any disclosable pecuniary interest or non-statutory disclosable interest?
Yes, thank you. John Walker, I'm a retired member of this scheme and my son and daughter-in-law are both deferred members.
Thank you. Okay. So move on to item 2, which is the public minutes of the Pension Fund Investment Subcommittee held on the 26th of May 2022. We are being asked to approve the public minutes of the subcommittee held on the 26th of May as an accurate record. Can I ask if any member who does not agree with the proposal to raise their hand now? Okay, I see no objections to the proposal to approve the minutes as an accurate record, so we will take that as carried unanimously. Thank you. Okay, move to item 3, the action log. Officers, do you have any comments or updates?
Thank you, Chair. There's only really one item that's worth any update outside what's on the report itself. That's item number 8, which is the second one down. As you'll all remember, we've done our private equity options meeting on the 6th of September. That went well, I hope you'll all agree. So hopefully we'll be bringing some decisions forward for the November ISC to decide on which of those passive options we choose to go forward with. Other than that, though, there's nothing worth update outside of the report.
Thank you. Members, any questions? Okay, I see nothing. So we are asked to note the action log. Are we happy to do so? Thank you. Okay, members, we have received here. Right. Is that in the right order? So we have received one public question, which I will take at this point in the meeting. The question has been circulated to committee members in advance of the meeting and is also available with the agenda and meeting papers on the County Council's website. Can I ask the Deputy Democratic Services Manager to read out the question?
Thank you, Chair. The question is as follows. I'm writing to you on behalf of the Cambridge chapter of the organisation Mothers Climate Action Network, a network of mothers across Cambridgeshire. We are gravely concerned by the ongoing extraction of fossil fuels by companies around the world and the impacts of the use of these fuels. To reach the UN's Paris Agreement goals on climate change, the International Energy Agency recommends, quote, a huge decline in the use of fossil fuels. Fossil fuels are also a financial risk, with fossil fuel investors having lost $132 billion in the last decade. It is clear that continued investment in fossil fuel extraction is not sustainable. We note your response to Councillor Hannah Copley's question to the Pension Fund Committee Investment Subcommittee. We see that the committee was expected to finalise plans to fully decarbonise the fund's portfolio in early 2022. Would the members of the committee confirm whether these plans have been finalised and release the plans and timelines for public scrutiny? Are these plans in collaboration with other county pension funds in the access pool? If these plans are not yet available, could the committee confirm a timeline for their release? We also note from the above response that your approach is one of engagement rather than blanket divestment. Would the members of the committee tell us how they intend to engage with fossil fuel companies and what metrics they intend to use to judge the success of this engagement? What actions have been taken thus far to engage with fossil fuel companies? And that's the end of the question.
Thank you. I would like to thank, on behalf of the Pension Fund Investment Subcommittee, the Mothers Climate Action Network for making the time to make representations to the subcommittee. Can I ask Mark Whitby, Head of Pensions, to respond to the points made?
Thank you, Chair. And this is a response that has been developed in consultation with the Chair and the Vice Chair. The committee very much shares your concerns regarding the impact of the climate crisis and is developing plans to carefully transition its assets into a more sustainable portfolio measured by the overall carbon footprint of all investments. This includes not only divesting from specific companies principally involved in the extraction of fossil fuels, but also by investing in lower carbon activities. This will ensure its primary fiduciary responsibility to scheme members is upheld, maintaining both the returns needed to pay members' pensions and having a diverse investment portfolio. The fund has published on its website a climate action plan, a climate dashboard and decarbonisation pathway for the fund. The latter targets a 23% reduction in absolute carbon emissions by 2024 and from a 2021 baseline, and a 57% reduction by 2030. Climate-related financial information based on the Task Force on Climate-related Financial Disclosures, TCFD, requirements will also be published within the fund's annual report and statement of accounts by the end of 2022 for the 21-22 scheme year. As one of the first key activities of the Climate Action Plan, the Investment Subcommittee has been exploring lower carbon and more sustainable solutions to its current passive holdings, which contain a significant proportion, 52% of the fund's carbon footprint. These considerations have included exploring the rapidly developing sustainable investments in partnership with other pension funds within the access pool. The November meeting of the Investment Subcommittee is expected to make decisions regarding the managed transition of the passive portfolio. The fund receives regular reporting on stewardship activities, including voting and engagement undertaken by its investment managers and collectively by the Local Authority Pension Fund Forum, LAPFI, on behalf of the fund. On November 22, the Investment Subcommittee will receive a quarterly stewardship report, enabling improved consideration of stewardship activities and discussion of engagement priorities.
Thank you, Mark. We will now consider the Cambridgeshire Pension Fund Investment Monitoring Report for the quarter ended 30th of June 2022. Can I ask Chris West to present this report?
Thank you, Chair. So I will start on the executive dashboard, which is in page 15 of meeting packs or page 2 of the paper copies that we have in front of us. And really, if we start on the top left-hand side quadrant, which is funding, there are essentially 2 different ways that we can look at Q2. Firstly, assets fell significantly over the quarter across the majority of asset classes, and that resulted in a fall of the fund's assets by 179 million over the quarter. However, from a funding perspective, it was a strongly positive quarter. So liabilities fell by a greater degree due to the rising yield environment, with the fund's funding level rising from 114% at the end of Q1 to 127% at the end of Q2. And that compares with the funding level of 100% at the previous valuation. In terms of headline asset allocation, so the green quadrant on the top right, across equities, alternatives and fixed income, each asset class was broadly aligned with strategic targets. You do expect a degree of of deviation there. The significant fall that we saw across liquid markets, across listed equities and across fixed income has helped to address a previous underweight position across the alternatives portfolio. So alternatives is now slightly overweight at its target allocation. Performance, which is the bottom left quadrant. So we touched on absolute returns being negative across most asset classes, and that's translated to a 4.3% negative return for the fund's asset portfolio over the quarter. However, in relative terms, there is outperformance versus the benchmark, so around 2% ahead of the benchmark return. There are a number of drivers for that positive relative return. So long view, one of the global equity managers, outperformed their index. The equity protection strategy helped, so delivered some positive contribution as equity markets fell. That protection strategy increased in value. The private assets portfolio performed strongly over the quarter, so held up relatively strongly, and we'll touch on within the private assets portfolio across property, private equity and infrastructure. However, there were some detractors, and the most notable is the Blue Bay multi-asset credit strategy, which underperformed materially versus its benchmark over Q2. However, when you compare it with other similar types of funds that invest in similar asset classes, its returns aren't significantly out of line, given that we saw falls across those riskier bond type assets that multi-asset credit invests in. When we look over the slightly longer term, so 1 year, again, performance ahead of benchmark, so a marginally positive return over the year, 0.3%, whereas the benchmark return was minus 1.4%. And then moving to the 3-year return, so broadly in line with its benchmark, a positive return of 6.9% per annum over the 3-year period, which is one of the drivers of that funding level increase that we've seen, that we touched on earlier. The following page covers the market backdrop. So you'll see lots of negative returns there across equity markets. So all regions were impacted with negative returns. Similar case with bonds and fixed income gilts, with sharp drawdowns, but positive returns for property. And then on the right-hand side, commodities, which is unsurprising given we've seen that commodity inflation really starting to drive global inflation. And that 3-month position kind of tells the story of the 1-year period. When you look at the 12-month returns below, it's a similar story with negative returns across listed assets, so equities, gilts, bonds, with positive returns for property, and then significant positive returns for commodities. Now, why have we seen this market environment? Again, this won't be a shock. It's inflation. Inflation isn't just a UK problem. It's something that is being experienced across the globe, given the drivers of inflation. And so central banks across the globe are continuing to increase interest rates to try and rein in this rising and this persistently high inflation. And the pace of those interest rate rises has increased, and it has been more steep than the market anticipated last year, when perhaps inflation was seen as possibly transitory and potentially easier to rein in. That's put downward pressure on bond prices. So bond prices are fixed payments in future. So in today's money, if interest rates are higher, they're worth less, and that's what drags the value down for bonds and results in the negative return. For equities, the impact is largely around the deteriorating growth outlook. So as central banks increase interest rates, that has a knock-on impact on growth and on growth expectations. And as those growth expectations have started to deteriorate again, that's had a knock-on effect on equity markets in particular. So corporate profitability expectations are down. And when we put this into context, so the Fed, the US central bank, has been raising rates in 0.75% increments in each of the last 3 meetings. The most recent one was yesterday, where they continued that pace, which is largely unprecedented in recent years, just that significant pace of increases. And similarly, we've seen the UK Bank of England increasing the base rate. And now currently markets have priced in a base rate of 4.5% next year. I'll move through a few pages to page 21 of the meeting pack, or page 5 of the paper copies, just to touch on the asset allocation position at the end of Q2. So you'll see on this page, there's a pie chart on the left-hand side, which covers the existing investment strategy and the strategic target allocations across the different asset classes. And then on the right-hand side, we have a bar chart, which represents how each of those actual allocations compares to the strategic target. I guess the key takeaway is that there are some deviations. We will always expect there to be. Actually, when you look at the scale at the bottom, they're largely range bound between plus and minus 1%. So the actual investment portfolio is broadly in line with target. Just to bring us up to a more recent position. So based on where we were at the end of last week, what we've seen is a rebound in some equity markets. US equities in particular were up around 9% over the quarter to date as it closed last week. Other regions do have positive returns. So what we're likely to see is that over Q3, if we look at that bar chart today, we would probably see a more overweight, or we would expect to see a more overweight position to global equity. And we've also seen yields continue to rise, given that pace of interest rate rises has continued into Q3. And that's resulted in further negative returns for bonds. So again, we would expect to see a more negative or more underweight position across bonds if we were to look at that position today. I'll move on to the individual manager returns, and we'll look through the drivers of investment performance. So this is page 27 of the meeting packs, and it's page 9 of the paper copies. And I'll start at the top with equities. So if we look at global equities on the whole, they delivered a negative return over Q2. But they did outperform the global equity index. So that minus 9% effectively represents the benchmark across the equity portfolio. And minus 8.6% was the return delivered by the MSCI World Index. The equity protection strategy, as I touched on in the executive summary, added value and provided some protection over the quarter, as it's designed to do. That's its job in falling markets. It should help to limit those losses. And so it's had a positive impact of around 0.9%. So minus 6.9% return over the quarter when you factor in the equity protection strategy. When we look at the individual managers, so the active global equity managers, the stories are quite different and the results are quite different. And some of that can be explained by the investment market that we've seen and the styles followed by each of those investment managers. So Joe Hambro, the first line there, so they underperformed over the quarter, and that follows a trend over recent quarters where they have underperformed the index. When you look at the longer term returns, so moving from left to right here, the story is more reassuring. So over 3 years, slight underperformance. Over 5 years, they are ahead of their benchmark. That's again partly explained by style. So Joe Hambro invests in a way that they will build a portfolio that tends to tilt away from value, so away from the type of companies that are defensive in nature and have strong book values and robust cash flows relative to price. And that's worked against them. So the market environment has tended to favor those more defensive type equity stocks and tended to be out of favor for more growth type stocks. That takes us on to Dodge & Cox, so the second line, and they're due to present later in the meeting. Now, Dodge & Cox follow a value style, so quite different to Joe Hambro's, and that's resulted in them outperforming the index over the quarter quite materially. So minus 2.5% is a much stronger return than the minus 8.6%, which is the overall global equity market. And in the report, we'll see that they've actually also outperformed the value index, so minus 3.8%, which is an index return that's essentially comparable for similar types of equity portfolio investments. When you look at the 1 year period again, Dodge & Cox's returns are positive, so 4.5% over the year, whereas the wider global equity index delivered a negative return. Again, in the report, you'll see them compared with 5.3% return, which is the value index. So how do other, if you essentially cut the global equity market in half into value and growth, the value index has returned 5.3%. So they're performing broadly in line with how you'd expect a value type manager to perform. And again, that's fed through into the longer term returns. So 3 years, the strongest performing manager, outperforming both the value index and the wider global equity index. And similarly, strong returns over the 5-year period. And then finally, Longview. So Longview, again, have outperformed over the quarter, and this follows recent quarters where performance has been stronger. The result is the 1-year return of 3%, a positive return of 3% versus an index return of minus 4.2%. Now, when you move beyond the 1 year, there were periods of underperformance, which have fed through. And when we look at the since inception return, so just over 2 years they've been in the portfolio, they are 1% behind the index. But certainly over more recent quarters, they've regained some of the ground that was lost. Fixed income towards the bottom of this table, and we'll start with Schroders bonds. So essentially these are passive gilts, so long dated government bonds, and they fell around 20% in Q2 and a similar magnitude over the 1 year period. And again, this is driven by the rise in yields. The rise in interest rates mean that the value of a bond today is worth much less in a high interest rate environment, and that rising interest rate has pushed down the value in those bonds. Now, essentially, they're held as a proxy, as a hedge against the liabilities. So again, as we talked earlier around the funding level and the fall in liabilities, the liabilities in these long-dated passive bonds will tend to move in a similar fashion. So actually, from a funding level perspective, the rising rates has helped funding level, but for this passive bond portfolio, it's resulted in a significant negative return over the year. Multi-asset credit towards the bottom of the page. So there are 2 multi-asset credit managers, Blue Bay and M&G, and both of them invest in bond type assets, but the riskier end of the spectrum. So bonds with some credit risk associated with holding them in turn to try and deliver outperformance over risk-free bonds. Blue Bay of the 2 managers are the more punchy in nature, so they invest in riskier subsectors of the multi-asset credit market, and that's come through in the returns. So when times are good for multi-asset credit and when assets are rising in value, you would expect Blue Bay to perform more strongly than M&G, who are more defensive. And in the environment we've seen over the quarter where markets are falling, it's largely expected that they would underperform given the risk profile of their fund. So minus 9.5% over Q2. Again, when you look at the benchmark here is based on cash. Therefore, it's a suitable long-term benchmark when you look through a market cycle, but over a short-term quarterly basis, you wouldn't expect the multi-asset credit manager in this environment to have outperformed that benchmark. And when you compare them with other managers of their style, they're certainly not out of place. We've seen significant negative returns across the different asset classes that they invest in. So high yield bonds, emerging market debt, and other types of securitized credit. M&G I touched on as being the more defensive of the 2, and again that comes through in the numbers. So there is a negative return, minus 0.7% over Q2, and minus 1.4% over the year. So they're essentially doing their job as a more defensive multi-asset credit manager in limiting the downside in these market downturn events. The 1 year figures do mask a period of relatively strong performance that came through following investment in 2020. So actually the since inception numbers are more reassuring. And then I'll move on to the following page, which essentially wraps up the quarterly report, and then I'll pause for any questions. And this covers the alternatives portfolio. I won't run through each of these line by line, but what you will see is a different story across the alternatives portfolio, so a positive return over the quarter. And there are some caveats, some reasons for that I'll try to bring out. If we focus first on property, So it was a positive quarter for property assets. Schroders core property portfolio, again, delivered a positive return and had a very strong 1 year performance in absolute terms, so 18.5% return. Residential property, again, a positive Q2, and the 1 year return of 5.3% is nudging closer to the 6% target that's been set. You may recall that in previous quarters or prior to this year, the residential property portfolio struggled to keep pace with that 6% target because its return profile, it largely relies on income, on rental income to deliver that return. And they were slow to rent out some of the new developments because of the COVID pandemic. So again, reassuring that as rental markets have got back to normal, that return is starting to approach the 6% target. The one thing to note for property, and it's similar across private assets, is that they are valued less frequently than listed markets and liquid markets. Therefore, what you will tend to see is a slight lag. So where we see a downturn in economic growth expectations, that comes through very quickly in listed equity markets. However, it may take more time to come through into private asset portfolios. So if we see a continuation of negative growth sentiment, or perhaps even a deterioration from here, or it's persistent and lasts longer, you may start to see some shorter term negative returns come through in those portfolios. However, the longer term returns are quite resilient, and so hopefully provide a degree of a buffer against any short term returns. Private equity is essentially the next asset class here, and again, the returns are strong. The benchmark returns here are listed equity. So we hold private equity to try and deliver a return above listed equity for taking on the additional risk, so the private market risk, the illiquidity risk of investment, and they have outperformed. Again, a caveat here is that given the time scales between quarter end and actually receiving the valuations, these values are lagged. So essentially they're a quarter behind. So again, we may start to see those shorter term returns come down from the high levels that we see here. But the 1 and 3 year returns and even 5 year returns across private equity, all well above 20% on an annualized basis. Infrastructure towards the bottom of the page, it's a similar story. And if we focus in particular on IFM and JP Morgan at the bottom of the page, so they are the two larger open-ended infrastructure portfolios where investments has been directed to over recent years. And again, positive returns over Q2. So they've held up relative to liquid listed markets. They do have a higher degree of inflation linkage with the underlying cash flows and underlying assets. And therefore that's come through in both lower volatility and those positive returns over Q2. I'll perhaps pause there now for any questions or comments.
Chris.
Thank you, Chair. I wonder if I may ask a series of questions, if you don't mind, just so that I can get something clear in my mind, which probably should already have been clear in my mind, probably has already been explained, and I've managed to forget it. So my apologies if that's the case over the last couple of years. The benchmark figures, which we have under the manager allocations, so the net manager performance, those are benchmark figures which have been created by Mercer based on so this is meant as a question, make it sound like a statement. Am I correct in thinking that those benchmark figures are ones which Mercer have created based on your knowledge and experience of the markets concerned to try and produce a comparative to that particular type of investment that we're talking about in each individual case?
Largely, yes, but developed in collaboration with investment managers. So investment managers will also have their own targets and their own benchmarks that they seek to outperform. Some of them are more relevant over the longer term. So for example, multi-asset credit, we touched on, the managers are targeting a long-term return of cash plus a margin, and that's reflected in the benchmark. So they aren't necessarily what we would consider as what you would expect those managers to deliver over the short term. For example, multi-asset credit, certainly 0.2 and 1.2% returns are almost unachievable by investing in the types of assets they invest in. yes, we work with the investment managers, we work with officers in providing these reports. We do aim to show relevant benchmarks for each of the mandates.
Okay, thank you. That's very helpful. Going back to page 2, where we have the performance, which is shown under longer term performance, bottom left-hand page of page 2 on the paper copy. And we have benchmark figures given for 1 year and for 3 years. Would I be correct in thinking that those benchmark figures are the accumulation of all the individual benchmark figures we see later, weighted according to the amount of investment there is in those particular funds?
That's exactly right.
Okay. So especially in the short term, the 1 year figure isn't necessarily, we're not necessarily comparing like with like when we're looking at the fund percentage increase as opposed to the benchmark percentage decrease, which would be expected. However, as you increase in terms of time, you'd expect that to be a more realistic like-for-like comparator. Am I right in thinking that?
Yes.
Good. Now, looking at this, I look for some, first of all, I'm really grateful for the information which is given and also for the explanations that you give. I find them really helpful, really useful, and I learn a great deal at every single meeting. But what I would like to know is, how are we doing as opposed to a stricter comparator, which is the overall position that we have with the local authority pension funds across the country. And there is a lot of information on the LAPF database about how they do. It's especially produced, I know, on an annual basis where it becomes very clear, but I know that there are quarterly figures produced as well there. How am I correct in thinking that that would be a better comparator in terms of how we are doing as opposed to our colleagues in other local authority pension funds, rather than necessarily just looking at the benchmark?
That is an additional metric you can look at. I would say in terms of the order of magnitude, it falls further down. Why is that? It's because it just looks at performance. So you could build a portfolio that looked very, very attractive historically from a performance point of view, but runs a lot of risk, i.e. if you had your whole portfolio in certain equities, as I'm aware that some local government funds do, their performance looks really strong on a back test. So if you're just chasing that league table, what you can forget about is all the external inputs that are also really important when building a portfolio, and also thinking about the very particular position that the Cambridgeshire Fund is in, the fact that you are in a very strong position in terms of funding, so you don't necessarily have to take the same amount of risk because you don't have a funding deficit to close. So there's all those other factors that whilst that can be an attractive thing to sit on a league table of peers and see where you sit, it doesn't always, well, very rarely tells the full story. Now, in terms of benchmarks and assessing success and those sorts of things, the funding level is one benchmark. That aggregated benchmark we show is another one. Clearly, there is no one right metric to assess whether the fund is doing the right job. There's lots of different lenses that we need to look to. I'm not being deliberately opaque here, but there are a lot of different things we want to think about, which is effectively why, and we know this, we don't make decisions on the basis of this report. This just frames some information about where we want to focus efforts in terms of doing further work, as opposed to we just look at one set of numbers and say good or bad.
That's extremely helpful. Thank you, Chair. And I fully appreciate what you say, especially the difference again between short-term and long-term performance. But I used to, and maybe I should again, I used to subscribe monthly to the LAPF monthly magazine. And they have tables produced every couple of months. You see a big table produced comparing all of the local authority pension funds, and there are an awful lot of them. It's surprising how many there still are. And they produce these tables with different metrics throughout the year. And I've looked at that and I've seen exactly what you just said, the astonishing difference that there is between different local authority pension funds in terms of their asset allocation. And I've been quite shocked by that, and I've never fully understood why the variance should be as great as it is. I fully appreciate that each local authority pension fund will have its own challenges, its own requirements as far as funding is concerned, and maybe even its own risk appetite. But the difference between the different LAPFs is far, far greater than I would expect. Again, I'm looking here to see how can we, as members of this subcommittee, how can we have any sort of judgment that the overall balance that we've got is the right one? I look at that and think, well, how on earth have they come to such a different conclusion when the fundamentals are basically the same, even if some of the detail is different?
Yes, and I guess in part we do look at those average allocations when we come to strategy review time, but we certainly don't pin ourselves to them. We don't want to be a sheep with the herd. We want to think very critically about what the Cambridgeshire Fund wants in isolation. So we are aware of the kind of direction of travel, and we obviously advise different LGPS funds, so we can anecdotally talk about that. Why is there such a breadth of different allocations? There's all sorts of reasons, and I think particularly because individual pensions committees have the sovereign decision making over investment strategy, so it sits with very different groups as opposed to kind of a centrally defined thing, and the differences flow all the way from the very top in terms of what beliefs are, in terms of size, in terms of budgets, in terms of officer capacity to be able to work on different projects, in terms of budgetary requirements, just all the way through the investment strategy chain. There are differences that when you aggregate that up and look at what the output is after you go through all those levels, which is the investment portfolio, once you aggregate those up, you do see some quite material differences. You know, anecdotally, what we have seen, and I'm sure Sam has kind of seen similar things from his experience as well, is a reduction in the listed equity allocations, growth of alternatives portfolios, which is where the Cambridgeshire Fund sits. And when we looked at equity allocations, when we did the last strategy review, we were very much middle of the pack in terms of what that listed equity allocation was. That decision wasn't, as I say, a consequence of following the pack. It was just an output that we tested against the market. Now, if you'd run a much higher listed equity allocation up until the start of this year, your performance would have looked stronger, possibly, and you would have sat higher up that league table, but that's not necessarily the right thing to do. So it's all these different inputs that we need to calibrate against.
Thank you, Chair, and apologies for taking the time, but I'm still left. I'm very grateful for the answer you've given, and it is actually a good sign that, in terms at least of equity allocation, the herd is moving towards us. That suggests something positive in terms of what our position has been in the past. But it still leaves me, as a member of this subcommittee, not really knowing how we can judge the direction of travel we should be going in. And I very much welcome the advice, the professional advice that you give, and that's very much welcome. But it still leaves me wondering, what is the metric that we should be using to think about where we should be in the future? And this is part of the story. What you give us here, although it is backward looking, it does tell us to some extent what we might be considering for the future. But I still feel as though we're missing a significant bit of information here.
I don't know, Sam looks like he wants to come in.
Can I bring in Sam?
Yeah.
Thank you, Chair. I was just going to suggest that with the upcoming strategy review, which is specifically going to be addressing asset allocation, perhaps it would be an opportune moment to take a look at the wider picture, whilst it's not, as has been very well explained, there's a multitude of reasons that funds end up in slightly different or significantly different situations. And I suspect with the challenges we're facing going forwards with the carbon and responsible investment and sustainable investment, different funds will also take slightly different approaches to those challenges, which may well send people off in different directions. But that strategy review, which is very much on the horizon, and be a good chance to build in perhaps just a look across the industry.
Yes, thank you, Chair. I'm more than happy to leave this for the strategy review, but I wonder, in preparation for that strategy review and at the strategy review, if the table of LAPF asset allocations could be provided to us. I know there are, what, 100 or so of these, and some of them are truly massive ones, like some of the metropolitan transport authorities, and others are absolutely tiny. But I think that it actually provides us with questions that we can ask. And I think it might be actually useful to see what all of our colleagues across the LA sector, what they are doing and what difference there is between us and them. I think that might actually be a helpful bit of information for us and encourage us to ask even more questions.
Thank you for that. Whilst I think that it's obviously important to see where we sit in amongst these things, we've got to be very careful that we don't live our lives chasing figures. We should be actually doing what is right for the investments that we hold and the pensioners to which we have. Mark, did you want to?
Yeah, I mean, there's obviously in the universe, there's a few things going on, including some very mature schemes, indeed, some with no active members at all. So they're in very different positions. Of course, the other thing which hasn't been mentioned is the funding position and our ability, do we have the ability through our investment strategy and of course the movement in liabilities, but to deliver decreasing or more stable contributions to scheme employees and things like that. So on that metric, I think we're doing really healthy funding position leading into the valuation. There is downward pressure on contribution rates. Some will be able to go down. So those kind of things are obviously also fantastic. But the only thing I'll say around the discussion that's just been had is that I do remember very detailed discussions around things like in an environment which is favouring growth, do we maintain a significant value manager, and we did that to maintain diversification. Other funds may have done something completely differently. The equity protection was obviously a huge question for us, and that enabled us to actually keep a higher level of equities whilst also still take off some risk. I'll say no more because I think we can obviously save that for another day. But hope it's helpful.
I'm very grateful for all for that. Thank you, Chair. I'm fully happy to leave this until we have that larger review. And I have to say that some of the other local authority pension funds, there's some which are massive outliers. Massive outliers. I'm not suggesting for 1 second that we're an outlier. And if we were, I'm not saying that would necessarily be bad. It's just I think that the more information that we have in order to be able to make the decisions which need to be made, the better it is for us, to be quite honest, because I know that perfectly well, Mercers are perfectly willing to answer any questions we ask. It's not as though there's anything which is being hidden here, but our understanding as non-pension professionals, I think, needs to be increased as far as we possibly can. So thank you for that. I did have a second question to ask, if you don't mind, Chair, and my apologies for taking up the time. It's on page 4 of the paper pack, which the funding level graph since March 2016 valuation. And I find this a really useful summary of our overall position. I think it's massively valuable. And I just need to, may I tell you what my interpretation of the fall in the liability value is since from March 22 to June 22, and then you can tell me how badly wrong I am and what the real answer is. My best understanding of that is that at a time when you have greater inflation taking place, the liability that we have for pensions which are already in payment, the overall liability for that effectively will be reduced in real terms, whereas and that will overcompensate for any increase that there may be in liability for those pensioners who are, or those members of the scheme who are not yet pensioners, where the liability may increase. That was my that was my best guess as to the reason for the difference, the significant fall from March 22 to June 22 in the value of the liability of the fund overall. How badly wrong am I?
Close. So I mean, the inflation piece pushes up liabilities across the board. Now, the way you treat active and deferred, i.e. non-pensioners, is slightly different. The way you treat pensioners, it comes down to the actuarial bit. So the inflation increases pushed up liabilities because it pushes up the expected pension payments that we're going to pay out in years to come. What brings the value down is the level at which we discount those pensions back to present value, and that comes through in the increased interest rate that we proxy against long-term gilt yields, because we want to reflect what we think interest rates are going to be over the term until we start paying those pensions out. So it's that increase in long-term interest rates that's pulled down the value of the liabilities, which has moved for more than the inflation.
Which means there is both a push and a pull on this. The pull upwards, that is for those pensions which aren't yet in payment, where you're going to have a greater degree of liability than you have now, even after you discount, whereas the thought I've got the wrong way about the other side is that existing pensioners, the net present day value liability for existing pensioners will be deemed to be reduced. It's very helpful. Thank you very much indeed, Chair.
Thank you. Members, are there any other questions on the report? And Chris, nothing else to add?
No, that wraps up the report. Thank you.
Okay. Thank you. In which case, the subcommittee is asked to note the report. Are we happy to do so? Thank you very much, members. Okay. Following items on the agenda are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from consideration of the following items on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and that it would not be in the public interest for this information to be disclosed information relating to the financial or business affairs of any particular person, including the authority holding that information. May I ask if there is general consensus in support of the recommendation so that the subcommittee can take it now? Or if anyone disagrees, please indicate now. Okay. As the committee has resolved to move into private session, we will now close the public part of the meeting and stop the live streaming via YouTube. The next meeting is on the 17th of November